talking about infrastructure. Of course, you have to trust your city to do certain things because, well, I mean, they're supposed to be professionals who are kind of doing these things, who are telling you where you can dig or what bridges you should fix. Now, they're not always right. And the same, I think, can be said in the investing world. I mean, a lot of people trust the pros to always be getting things correct. A lot of people think you need maybe a professional in order to make more money on your investments. But sometimes, a lot of us aren't professionals. What advice do you have for people who are trying to, I guess, be a pro?
Well, I think trying to be a pro is the wrong thing to do for most people. It's like most occupations. There are certain aptitudes that are needed to be in the business. One of them is a very thick skin, and I'm not sure everybody has it. So using a professional is not necessarily a wrong thing to do. But what's happened in Wall Street in the last few years has been this idea that there are these professional organizations out there, whether hedge funds or whatever they are, and that they're dominating the market and that the individual investor has no chance against those pros. And I think that's wrong. In fact, I think when you get to the concentration where people start talking about all this technology and all the rest of the stuff, the individual investor actually has greater chance of beating the pros, than the pros do of being themselves, because it's really an apples and oranges comparison. When you compare yourself to somebody who's trying to beat the S&P 500, you may not have to beat the S&P 500 to make your goal. So it's an apples and oranges comparison. They're driven by different things than you are or I am in our personal investments. So the idea of beating a pro, you're probably not going to beat a pro at their game. But that doesn't mean that you can't beat him at your game.
Is that an interesting piece, though, to say you have to beat somebody? I mean, isn't that kind of like... is everybody really against each other in the market? I mean, they kind of are, right? Because everybody would take as much gains as they could, and nobody's like, I made all this money, and nobody thinks about the guy who lost it while you made it.
Well, that's the nature of Wall Street. The nature of Wall Street is it's at every transaction there's a winner and a loser. It's not true, because there can be winners on both sides.
Sure.
Somebody
lost.
Somebody lost. It's always a competitive environment, and it's always been that way, and that's never going to change. But for an individual investor, the cost of doing nothing is only their opportunity cost, which right now is what you could earn on that money in a bank, which is zero. So your opportunity cost is very low. So you can sit out there and you can wait. There was a famous story about George Plimpton, who used to go. He's a Harvard graduate and used to go and do sports. He would paid for the Detroit Lions and wrote a book called Paper Lion. Well, one time he went to Yankees training camp, and he wanted to hit against the Yankee pitchers. The rule was, though, that he had to swing. Or, excuse me, he was pitching against the Yankee hitters, and the rule was they had to swing. There were no called pitches. Well, he threw 147 pitches in 2 innings. And the batters just sat there with the bats on their shoulders till they got the right pitch. Mm-hmm. An individual investor is very much like that. They can stand at the plate with the bat on their shoulders. No one's making them swing. You wait till the deal comes that you like, and then you swing. The pros don't have that choice. They got to swing every time because they're trying to beat an unmanaged, an index with no costs associated with it, and they're trying to do better than that. Individual investors don't necessarily have to do that. So that's why I'm saying this competition with the pros is really the wrong index that you should be looking at. There's only one person an individual investor competes with, and that's themselves. That's it. If you satisfy your goals, what do you care if anybody else satisfies theirs by doing the S&P 500? Yeah, it might take you a little longer, but, if it's safer, fine.
If you sleep at night.
If you sleep at night. I mean, there's a famous story about the original J.P. Morgan that somebody ran up to him on the street and said, Mr. Morgan, I own so many stocks I can't sleep. What should I do? And Morgan said, sell them down to the sleeping level. And that's it. I mean, you shouldn't be in things that keep you awake at night.
Right. Do you, as you start to go through a professional versus I guess, I don't know what you want to call it, a novice or an individual investor, you start to see, and you start to see on Wall Street right now, these $1 million bonuses happening again. Huge, insane amounts of money. And really, those people are oftentimes beating the individual who, unlike the Yankees, are swinging at every pitch because of this instant gratification. And we talked about it a little bit at the break. It's in social media. It's kind of also in investing, isn't it? Right. I mean, somebody goes on ETrade and they want to do something, and then like 30 minutes later, they're probably checking, or an hour later, they're checking, or the next morning. And now they get this, they're on this emotional, almost gambling type of run.
Well, and that's what Wall Street has for the last few years. Wall Street has gradually morphed from being an era of I want to say, a consumptive capitalism where you invested money to make something great and create value, to a financial capitalism where the issue is to make money with money. It's part of the reason that we also have obesity issues and a lot of other things. This is not the result of being unsuccessful. There's so much money floating around because we are so successful as a nation that everybody has money to invest. But Wall Street, of course, is still about transactions. So they're going to try and encourage investors to make as many transactions as they can. And we were also talking about how nothing is priced at list anymore. Same thing with Wall Street. You see these guys at ETrade, we'll give you 100 trades for free, or we'll give you this for free. The idea is to entice you to get in. And if you think there's no cost to your trade, I got a couple of bridges I need to sell you real bad. I'll mark them down. Every time you do a trade, there is some cost taken out of your hide. And over time, if you used to do 10 trades and it cost you 1% to do 10 trades, and now you're doing 100 trades and it's costing you 1%, it's the same cost. Mm-hmm. So, but you're right. There's an instant gratification thing, which is what Wall Street wants you to do. That's why you see the ads for TD Ameritrade. When you're doing your trading, when you're doing this, it's all about trading. It's not about investing anymore. It's not about looking for the future and taking 3 to 5 years for these things. I mean, long term is the end of the week now.
Right. So when you start to see, as a professional, when people turn to you for advice, when you see people getting into an E-Trade account, and I don't want to bash E-Trade for any other reason. I'd bash
why not?
Other ones, but what I'm saying
they're
is,
not a sponsor, are they?
No, that's true. So, but as you start to see, people essentially buying into this. Oh my goodness! I mean, it's gambling. At that point in time, it is gambling, right?
It is. It is.
I mean, you might as well be on full tilt poker.
Yeah. If you go back and study investments, it's very interesting. The risk of owning an investment declines the longer you own it. The riskiest time for an investment is the short term. Is in short term. When you're in the short term, you're playing against those pros. You're playing against those algorithms. You're playing against all these mechanical traders out there
that you don't have.
They're going to kick your butt every time.
Right.
You're never going to win that game. If you want to play that game, fine, but you're never going to win it. What you've got to do is play the game that they're not playing. And the game they're not playing is buying good companies for good stocks and holding them long term. But to do that, one thing is absolutely necessary. You have to know yourself and know what it is you want and understand your personality. And it's very easy. I mean, I can't tell you how many people I get now calling me, telling me, shouldn't we be investing in Chinese internet stocks? Well, that might be true, Mrs. Smith, but you're 87 years old and you're in a nursing home. Where did you get this? Well, the nice young man on CNBC said this. I get this all the time. And I know these people, and I know they can't stand the volatility, either from a professional standpoint, monetary standpoint, or personality-wise. And so, I'm not cool because I have to tell them, no, you can't do that.
Right.
You shouldn't do that. It's not suitable for you. It's not in the best interest or whatever. But when the markets go up like this, there is this almost Pavlovian desire to go out there and kill something. Mm-hmm. And people say, everybody else is making money. Why can't I make money?
Dennis Gibb joins me with the Sweetwater Investments. Dennis, so here's the other piece. You know what I noticed is since the market has gone up, right? What are we? I don't know what it's at today. 15.4, 15.
It'll change.
Like
don't worry about it.
Right. Well, it doesn't matter. But now I notice more ads targeting people who have been on the sidelines.
Yep.
So now that I would imagine that a lot of pros are thinking, okay, we just had a pretty good run since it was at 6,000.
Yeah,
we're 150% over 4 or 5 years.
Yeah.
And now this is when the ads start targeting the people who've been sitting on the sidelines.
Sure. And it's just like you see when you reach a real estate bubble, you see the ads for flipping houses. Gold was the same thing. When gold was up at almost $2,000 an ounce, there were gold ads every day, thousands of them out there, and companies trying to do gold. It's the same thing. I mean, none of these people were around in April of 2009 when this thing bottomed out. And here's what you got to realize, that if the pros are asking you, trying to get you to come in the market, that's because they want to sell you something.
Right.
And Gibb's first rule of investment is nothing done on Wall Street is ever done for the benefit of the investor.
Isn't that kind of interesting? You trust these companies to do that, and they're really not in it.
They're not. I mean, like in everything else, you control your own fate, especially in America. And to control your own fate is an important freedom, but you got to know how to exercise it. And are you always going to be right? No, you're probably going to be wrong. You'll be wrong more times than you're right. I mean, this is a business where if you're right 33% of the time, you are a superhero. And that's hard. So it's easier to be right 33% of the time if you focus yourself on a few ideas that you know well, know those companies well, and know things that are going on. So you can get an informational advantage that is legal.
Dennis, do you still recommend that people buy companies they know? I remember growing up, maybe this was, I said growing up, I'm talking about we did in elementary school or middle school or high school, you do like these kind of stock trading things. And I remember this was before, there was no ETrade. There was, the internet was kind of new. But there was nobody saying, it had a lot to do with find companies you like. Find companies you do business with. Mm-hmm. And it seems like that has changed, at least from, granted from the story I was hearing then to the story I'm hearing now, which is more you can save money on your trades, no matter what it is, and you'll make more money. I mean, of course, that's the impetus of the reason people are investing. But like you said a little bit, it seems like people maybe are more involved in the wrong game. I mean, I think that's kind of the point of what you're saying. What percentage of people are in the wrong game? Well,
I think a lot of them are, and there is a peculiar personality trait which is American in itself, and I'm going to be very stereotypical here. Americans have this myth in their head that all they need is one big hit. All they need is one thing, and they can get rich overnight. And I remember one time I met the late singer Jim Croce, and I said to him, boy, you've really come on. You're like an overnight success. He says, yeah, except for the last 12 years of singing in bars and bowling alleys. The myth of the instant success is exactly that. It is a myth. It is something which people want to be true, but rarely is. Go through the Forbes 400 richest people.
I was just going to say, and they talk about all the failing businesses they have.
Go look at these guys. These guys are 70, 80 years old. These aren't 20-year-olds. There's a few of them out there that have caught some internet thing or whatever. But you're probably going to make money in an area that you understand and something you've spent the time learning about. It doesn't have to be exciting. I happen to know a lot about railroads. What's more uncool than a railroad, right?
Not to my kid.
Well, I know, but yeah, I like them too. But I've learned about
drop
railroads.
Them off at your house, actually.
Oh, yeah, exactly. And I went to some guy's house the other day. He's got a 5,400 square foot layout in his house.
Wow.
I mean, most of the house is this. So the point is, it goes on forever. But I like real trains, the big ones, and I know the industry well enough that I have an advantage over other people because I can see when things are changing. So I can nip into a company like CSX and make a 10% return, where other people wouldn't see that, and they would just see some changing metrics. So the key is not only to find stocks that you like or whatever, it's businesses you can understand. Come on, does anybody really understand Apple? Does anybody really understand Cisco? Does anybody really understand Juniper Networks or Easy Chip or the rest of them? No. Can you understand Coca-Cola? Sure. I mean, people hate McDonald's because of the thing, but you can't. Here's a company that was on its back a few years ago. They came up with Chipotle. They came up with a new menu. Man, the stock's just gone like crazy since then. So there are companies out there that are always going to do well, and there are companies out there that have an advantage. For example, property casualty insurance. You can't build a commercial building in the United States without having a property casualty plan. So somebody's going to sell it to them. So those guys, they may not grow very much, but if they're run right, a good insurance company has a license to steal.
Yeah, I mean, you talk about the different laws. I mean, you could look at the same thing that had happened in the mortgage industry. Okay. You could have been in the mortgage industry when they started slowly taking away loan programs back in 2008, before the collapse.
Right.
But when they just started pulling them back, that would have been a real good time in the mortgage industry, which I did not have the foresight to say. Of course, it's easy to say now.
Yes, it is.
But, if you really do understand it, that would have been a time where you're like, okay, wait a minute. We're losing programs. You're starting to hear this rumble. There's problems.
Right.
Of course, nobody did because everybody has that, hey, get rich quick, I think, mentality. Nothing's ever going to go wrong.
And there's a herd mentality of the top.
Yeah.
There's a herd mentality that goes at the top. Yeah, you're right. And also for the people out there who bought houses, when they're taking these, option arms with principal only or interest only, 3-year upside down if the orange crop comes in right, you get this movement. These people, they didn't understand the index. They didn't understand the option. All they saw was the fact that houses were going up at 25 or 30% a year, and they wanted to get in it, and they wanted to put the minimum amount of money down so they can make the maximum amount of money. Why? This is my chance to get rich. This is my Microsoft. This is my Apple. This is my Google or whatever. And it doesn't happen that way for the majority of people. The majority of people get rich slowly. They get rich by compounding return over time, not by making a big hit. And, even the guys who have made the big hits, look, Bill Gates had to spend 18 months living in a motel room with Paul Allen to be able to found Microsoft. Now, that's penalty enough for the money he's got.